Winter is coming, but when? These 7 facts will free you from the fears of correlation and crash. Power, the ability to shape and influence life circumstances, the fuel to produce extraordinary results. Where does it come from? What makes a person powerful? What creates power in your own life? When humans lived as hunter-gatherer, we had no power. We were at the mercy of nature. We could be ripped apart by various predators or destroyed by brutal weathers whenever we venture into the wild to hunt or scavenge for food. And food wasn't always there. But gradually, over many thousands of years, we developed an invaluable skills. We learned to recognize and utilize patterns. Most important, we observe the patterns of our seasons. We learn to take advantage to them. We learn to take advantage of them by planting crops at the right time. These capabilities move us from scarcity to abundance to a way of life which communities and eventually cities and civilizations could flourish. Our gifts for patterns recognized literally change the course of human history. Along the way, we also learn a vital and important lesson. We are not rewarded when we do the right things at the wrong time. If you plant in winter, you'll get nothing but pain, no matter how hard you work to survive and thrive. You and I have to do the right things at the right time. Our capacities for pattern recognition is also the number one skill that can empower us to achieve financial prosperities. Once you recognize the patterns in the financial markets, you can adapt to them, utilize them, and profits from them. So now I will give you that power. The majority of investors fails to take full advantage of the incredible power of compounding, the multiplying power of growth times growth by Burton Markell. So before we get to the heart of this chapter, let's just take 2 minutes to discuss a fundamental concept that I'm sure you already know, but one that we need to utilize and maximize in order to build lasting wealth. The first patterns we need to recognize is that there is miraculously powerful way to build wealth that's available to all of us. One that Warren Buffett had harnessed to amass a fortune that now stands at 65 billions. What his secret? It's simple, says Buffett. My wealth has come from a combination of living in America, some lucky genes, and compound interest. I can't vouch for your genes, though I'm guessing they're pretty good. What I do know for sure is that compounding is a force that can catapult you to a life of total financial freedom. Of course, we all know about compounding, but it's worth reminding ourselves just how impactful it can be when we truly understand how to make it work for us. In fact, our ability to recognize and utilize the power of compounding is the life-changing equivalent of our ancestors discovery that they could produce bountiful harvests by planting crops at the right time. Let's illustrate the tremendous impact of compounding with just one simple but mind-blowing example. Two friends, Joe and Bob, decide to invest 300 a year. Joe gets started at age 19, keep going for 8 years, and then stop adding to this pot at age 27. In all, he saved a total of 28,000. Joe's money then compound at a rate of 10% a year, which is roughly the historic returns of the US stock market over the last centuries. By the time he retired at 65, how much does he have? The answer is 1.8 millions. In other words, the modest investment of 28,000 has grown to nearly 2 million bucks. Pretty stunning, huh? His friend Bob get off a slower start. He began investing exactly the same amount, 300 a month, but doesn't get started until age 27. Still, he's a disciplined guy. He keep investing 300 every month until he's 65, a period of 39 years. His money also compound at 10% a year. The result, when he retired at 65, he's sitting on the nest egg of 1.5 millions. Let's think about this for a moment. Bob invests a total of 140,000, almost 5 times more than the 28,800 that Joe invested. Yet Joe has ended up with an extra 273,000. That's right, Joe ended up richer than Bob, despite the fact that he never invested a dime after age of 27. What explains Joe's incredible success? Simple. By starting early, the compound interest he earns on his investment add more value to his account than he could ever add on his own. By the time he reached age 53, the compound interest on his account added over 60,000 per year to his balance. By the time he is 60, his account is growing by more than 100,000 per year, all without adding another dime. Bob's total return on the money he invested is 1,032%, whereas Joe's return is a spectacular of 6,370%. Now let's imagine for a moment that Joe didn't stop investing at age 27. Instead, like Bob, he kept adding 300 a month until he was 65. The result, he ended up with a nest egg of 3.4 millions. In other words, he has 8.86 million there. He has 1.86 millions more than Bob because he started investing 8 years earlier. That's the awesome power of compounding. Over time, this force can turn a modest sum of money into a massive fortune. But you know what's amazing? Most people never take full advantage of his secret that's laying in full view. This well-building miracle that's sitting there right in front of their eye. Instead, they continue to believe that they can earn their way to rich. It's a common misconception. This belief that if your earned income is big enough, you'll become financially free. The truth is, it's not that simple. We all read stories about movie stars, musicians, and athletes who earn more money than God, yet ended up broke because they didn't know how to invest their income. After a series of lousy investments, the rapper 50 Cent recently declared bankruptcy despite having had a net worth estimates at 155 millions. Actress Kim Basinger, at the height of her popularity, was pulling in more than 10 millions per film, and yet she also ended up bankrupt. Even the king of pop, Michael Jackson, who reports signed a recording contract worth almost 1 billion and sold more than 750 million records, supposedly owe more than 300 millions upon his death in 2009. The lessons: you're never going to earn your way to financial freedoms. The real route to riches is to set aside a portion of your money and invest it so that it compounds over many years. That's how you become wealthy while you sleep. That's how you make money while you slave instead of being a slave to money. That's how you achieve true financial freedom. By now, you're probably thinking to yourself, yeah, but how much money do I have to set aside in order to reach my financial goals? That's a great question. As mentioned, to help you answer it, we have developed a mobile app that you can use to figure out exactly what you will need to save and invest. It's available at www.unshakable.com. Everyone's situation is unique, so I recommend you sitting down with a financial advisor to discuss your specific goals and how to reach them. But I want to warn you, most advisors grossly underestimate how much money you would like to need to be financially secure, independent, or free. Some say you should have a nest egg that's 10 times what you earn currently. Others who are a bit realistic say you will need 15 times. In other words, if you're making 100,000, you will need 1.5 millions. If you're making 200,000, you will need 3 millions. You get the idea. In reality, the number you should really aim for is 20 times your income. So if you currently earn 100,000, you will need 2 millions. It might be sounds like a lot, but remember that our friend Joe get there with a mere 28,000, and my bet is you will have much more than this to invest over the coming years. You can read about this in greater details in Money Master the Games, which has an entire section on this subject. As I explained there, it's easy to get overwhelmed when you look at huge numbers like this, but it's less intimidating when you start with an easier target. For example, maybe your first goal is to financial security, not total independence. How would you feel if you could cover the cost of your mortgage, food, utilities, transportation, and insurance, all without ever working again? Pretty great, right? The great news is this number is usually 40% less than ultimate financial independence, where everything you need is paid for, and thus you can hit it quicker. Once you hit that target, you have built up so much momentum that the bigger numbers won't feel like such a stretch. But how are you going to get there? First, you got to save and invest, become an owner, not just a consumer. Pay yourself first by taking a percentage of your income and having it deducted automatically from your paycheck or bank account. This will build your financial funds. This will build your freedom fund, the source of lifetime income that will allow you to never have to work again. My guess is you already doing this, but maybe it's time to give yourself a raise. Increase what you save from 10% of your income to 15%, or from 15% to 20%. For some people, 10% may seem impossible right now. Maybe you are at a stage in your life when you have student loans or major obligation to your family or a business. No matter what your situation, you have to take the first step and get underway. There's a proven method called Save More Tomorrow, which I describe in chapter in which I describe in details in chapters 1.3 of Money Master the Game. You start by saving just 3% and gradually raise this to 15% to 20% over time. Now that you have saved it, where are you going to invest for the maximum return so that you reach your target faster? The single best place to compound money over many years is in the stock market. We discussed the importance of putting together a diversified portfolios that include other assets. But for now, we are going to focus on stock market. Why? Because this is incredibly fertile land. Like our ancestors, we need to plant our seeds where we can reap the greatest harvest. Where should I put my monies? As you and I both know, the stock markets have made millions of people rich over the last 200 years. Despite many ups and downs, it's been the best place for the long-term investor to build wealth. But you need to understand the market's pattern. You need to understand its seasons. That's what this chapter is all about. What's the biggest financial questions of all of our minds today? In my experience, we are searching for answers to pretty much the same questions. Where should I put my money? This question has become more urgent lately because all of the answers seems unappealing. In an era of compressed interest rate, you are earning nothing when you keep your cash in a saving account. If you buy a high quality bond, for example, if you lend money to the Swiss or Japanese government, you earn less than nothing. There's a joke going around that traditionally safe investment like this now offer return-free risk instead of risk-free return. What about stocks? Hundreds of billions of dollars from all over the globe have poured into the US stock market, which many people regard as a relatively safe haven in an uncertain world, but has created even greater uncertainty because US stock price and valuation have soared over the past 7.5 years, fueling fears that the market is bound to plummet. Even people who have done well in this rising market are worried that the whole things could fall, that there's nothing pumping it up except the central banks and their crazy policy. So what should you do? Prepare for the stock market meltdown by selling everything and running to the hills? Keep all of your money in cash, earning zero, and wait till the market plummets so you can buy in at lower price? How but how long you but how long can you wait? What about all those unfortunate souls who have already waited for years, missing the entire bull market? Or should you stay in the market, sit tight, close your eyes, and assume the brace position as you prepare for impact? I told you none of these options sounds that enticing. As you know, humans have a tough time handling uncertainty. So how are we supposed to make intelligent decisions in this environment? environment where everything seems uncertain. What can we do if we have no idea when the market will plummet, when the financial equivalent of winters will finally arrive? But I got news for you. We do know when winters will arrive, but how? Because when we took back at the stock markets over an entire century, we discovered this an extraordinary fact: financial winters comes on average every years. Once you start to recognize long-term patterns like this, you can utilize them even better. Your fear of uncertainty melts away because you see that important aspects of the financial markets are much more predictable than you ever realize. So, we are going to walk you through 7 facts that will show you how the markets work. You learn that certain pattern repeat again and again, and you learn to base your decisions on an understanding of those proven patterns, just like our ancestor who discovers that planted seeds in spring was a winning strategy. Of course, nothing is ever entirely certain in farming, financial markets, or life. Some winters arrive sooner, some later, some are severe, some are mild. But when you stick with an effective approach over many years, your probabilities of success increase massively. What separates the money masters from the crowd is this ability to find a winning strategies and stick with it. So the odds are always strongly in their favor. Once you understand the 7 indisputable facts we are about to explain, you will know how the financial season works. You will know the rules of the game, the principles on which it's based. This will give you an enormous edge since even many experienced and sophisticated investors don't know these facts. Armed with this knowledge, you can get in the game, stay in it, and win. Best of all, these facts will free you from all the fears and anxieties that dominates most people's financial lives. That's why we call them financial facts or freedom facts. And let me tell you, the ability to invest without fear is critically important. Why? Because so many people are so paralyzed by fear that they can barely bring themselves to dip their toes in the water. They are terrified the stock markets will crash and wash away all of their hard-earned savings. They are terrified that stocks will nosedive right after they invest. They are terrified that they will get hurt because they don't know what they are doing. But as you will soon discover all those fears will quickly fall away once you understand the pattern of facts that you are going to reveal over the next few pages. But before we get started, but before we got start, but before we get started, let me quickly explain some investment jargon. When any market falls by at least 10% from its peak, it's called a correction, a peculiar, bland, and neutral terms for an experience that most people relish about as much as dental surgery. When a market falls by at least 20% from its peak, it's called a bear market. We'll begin by sharing some surprising freedom facts about correction. Then we will turn our attention to bear markets. Finally, we'll explain the most important fact of all: the biggest dangers. The biggest danger isn't a correction or a bear market, it's being out of the market. So, freedom fact 1. On average, corrections have occurred about once a year since 1900. Have you ever listened to the pundits on CNBC or MSNBC talking about the stock market? Isn't it amazing how dramatic they can make it sound? They love talking about volatilities and turmoil because fear draws you into their programming. They're constantly analyzing mini crises that prognosticators predict could trigger market mayhem. The crisis in questions might be unrest in the Middle East, slumping oil price, and downgrading the US debt, a fiscal cliff, a a budget standoff, Brexit, a China slowdown, or whatever else they can milk for excitement. And by the end, and by the way, if you don't understand these things, don't worry. Most of these experts don't either. I don't blame them for peddling drama. It's their job. But between you and me, none of this is really that exciting. A lot of it is just to stop. Hype up to stop you from reaching your remote control. The trouble is all this babble, all this drama, all this emotion can make it hard for us to think clearly. When we hear these experts speaking in grave voice about the possibilities of a corrections or a crash or crisis, it's easy to become anxious because it sounds like the sky is about to fall. It might make for good TV, but the last thing you and I want is to make fear-based financial decisions. So we have to remove as much emotion as possible from this game. Instead of getting distracted by all this noise, it helps to focus on a few key facts that truly matters. For example, on average, there has been a market correction every year since 1900. When I first heard this, I was floored. Just think about it. If you are 50 years old today and have a life expectancy of 85, you can expect to live through another 35 corrections. To put it another way, you experience the same number of corrections as birthdays. Why does this matter? Because it shows you that corrections are just a routine part of the game. Instead of living in fear of them, you and I have to accept them as regular occurrence like spring, summer, fall, and winter. And you know what else? Historically, the average correction has lasted only 54 days. Not less than 2 months. In other words, most corrections are over almost before you know it. Not that scary, right? Still, when you're in the midst of correction, you might find yourself becoming emotional and wanting to sell because you are anxious to avert the possibilities of more pain. You are certainly not alone. These widespread emotions create a crisis mentality, but it is important to note that in the average correction over the last 100 years, the market has fallen only 13.5%. From 1980s through the end of 2015, the average drop was 14.2%. It can feel pretty uncomfortable when your assets are taking that kind of a hit. And then uncertainty leads many people to make big mistakes. But here is what you have to remember. If you hold tight, it's highly likely that the storm will soon pass. So freedom fact 2. Less than 20% of all correction turn into a bear market. When the market starts tumbling, especially when it's down more than 10%, many people hit their pain threshold and start to sell because they are scared that this drop could turn into a death spiral. Aren't they just being sensible and prudent? Actually, not so much. It's turned out that fewer than 1 in 5 correction escalates to the point where they become a bear market. To put it another way, 80% of correction don't turn into bear market. If you panic and move into cash during a correction, you may well be doing so right before the market rebounds. Once you understand that the vast majority of corrections aren't that bad, it's easier to keep calm and resist the temptation to hit the inject button at the first sign of turbulence. So freedom factory. Nobody can predict consistently whether the market will rise or fall. The media perpetuates a myth that if you are smart enough, you can predict the market's moves and avoid its downdrafts. The financial industry sells the same fantasy. Economists and market strategists from big investment banks confidently predict where the S&P 500 will stand at the end of the year, as if they have a crystal ball or equally unlikely superior insight. Newsletter writers also love to act like Nostradamus and warn you of the coming crash, hoping you'll feel compelled to subscribe to their surveys so you can avoid this fate. Many of them make the same dire predictions every year until they are occasionally right, as anyone would be. After all, even a man with a broken watch can tell you the correct time twice a day. These self-proclaimed sirs then use that accurate predictions to market themselves as the next great market timer. Unless you are wise to this trick, it's easy to fall for it. Some of these folks may actually believe in their own powers of prediction. Others are just like salesmen. So take your pick. Are they idiots or liars? I couldn't possibly say, but I will tell you this. If you ever attempt to take them seriously, just remind yourself of this classic remark from the psychiatrist Neil Bohr. Prediction is very difficult, especially it's about the future. I'm not sure how you feel about the tooth fairy or the Easter bunny. But when it comes to our finance, it's best to face facts. And the fact is, nobody can consistently predict whether markets will rise or fall. It's delusional to think that you or I could successfully time the market by jumping in and out at the right moment. If you are not convinced, here is what two of the wisest masters of the financial world think of market timing and the challenging of predicting markets movement. Jack Bogle, the founder of Vanguard, which has more than 3 trillions in asset under management, he said, sure, it would be great to get out of the stock market at the high and back in at the low. But in 65 years in the business, I not only have never met anybody that know how to do it, I never met anybody who had met anybody that knew how to do it also. And Warren Buffett had said, the only value of stock forecasters is to make fortune tellers look good. Still, I have to confess, it's fun to watch all these market pundits, commentators, and economists make fools of themselves by trying to pinpoint a correction. Look at the chart on the following page. I will see what I mean. One of my favorite examples is economist Dr. Nouriel Roubini, who predict wrongly that there will be a significant stock market correction in 2013. Roubini, one of the best known forecasters of our time, was nicknamed Dr. Doom because of his many prophecies of disaster. He successfully predicted the 2008 market meltdown. Unfortunately, he also warned of a recession in 2004 wrongly, 2005 wrongly, 2006 wrongly, and 2007 wrongly. In my experience, market seers like Roubini are clever and articulate, and their arguments are often compelling, but they strive by scaring the living daylights out of you. And they've been wrong again and again and again. Sometimes they get it right, but if you listen to all of their scary warning, you will end up hiding under your bed, clutching a tin box containing your life saving. And let me tell you a secret. Historically, there's not been a winning strategy for a long-term financial success. Merchant of Doom. If you would like, take a moment and look at these 33 failed predictions by self-appointed market forecaster. Each of the number below corresponds to the date of the prediction in the graph. The common pattern is they are all predicting that the market will go down when it's actually going up. Freedom Facts 4. The stock market rise over time despite many short-term setbacks. The S&P 500 index experienced an average intra-year decline of 14.2% from 1980s through the end of 2015. In other words, these market drops were remarkably regular occurrence over 36 years. Once again, nothing to be scared of, just a matter of winter putting its usual seasonal appearance. But you know what really blows my mind? As you can see in the chart below, the market ended up achieving a positive return in 27 of those 36 years. That's 75% of the time. Happy ending. Despite a 14.2% average drop within each year, the US market ended up with a positive return in 27 of the last 36 years. Why is this so important? Because it reminds us that the market generally rises over the long run. Even though we hit a huge number of potholes along the way, you know as well as I do that the world had its fair share of problems over those 36 years, including 2 Gulf Wars, 9/11 in conflict in Iraq and Afghanistan, and the worst financial crisis since the Great Depression. Even so, the market ultimately rose in all but 9 of those years. What does this mean in practical terms? It means that you and I should always remember that the long-term trajectory is like to be good. Even when the short-term news is dismal and the market is getting smacked, we don't need to get bogged down in economic theory here, but it's worth mentioning that the US stock market typically rise over time because the economy expands as American companies become more profitable, as American workers become more efficient and productive, as the population grows, and as technology drives new innovation. I'm not saying that every company or every individual stocks will do well over time. As you and I both know, the business world is a Darwinian jungle. Some companies will die and some stocks will fall to zero, but one big advantage of owning an index funds that track a basket of stocks such as the S&P 500 is that the weaker company intermittently get cooled and replaced by stronger one. Survival of the 15 in action. The greater thing is that you benefit from this upgrade in the quality of the companies in the index. How? Well, as a shareholder of an index fund, you own part of the future cash flow of the company in that index. This means that the American economy is making you money even while you're asleep. But what if American economy future is lousy? It's a fair question. We all know there are serious challenges, whether it is the threat of terrorism, global warming, or social security liabilities. Even so, this is an incredible, dynamic, and resilient economy with so powerful trend driving its future growth. In his 2015 annual report, Warren Buffett addressed this subject at length, explaining how population growth and extraordinary gains in productivity will create an enormous increase in wealth for the next generation of economy or of America. This all-powerful trend is certain to continue. America's economic magic remains alive and well, he wrote. For 240 years, it's been a terrible mistake to be against America, and now is no time to start. Freedom Fact 5. Historically, bear market have happened every 3 to 5 years. I hope you and I are starting to see why it's a good idea to be a long-term investor in the stock markets and not merely a short-term trader. And I hope it's now equally obvious that you don't need to live in fear of correction. Just to recap for a moment, you know now that correction happen regularly, that nobody can predict when they will happen, and that the market usually rebounds quickly, resuming its general upward trajectory, and any fear you once felt should turn to power. Believe me, these fears hits me like a revelation. Once I understood them, all of my concern about corrections melt away. Here was factual proof that the snake was nothing but an inert root. But what about bear markets? Shouldn't we be terrified of them? Actually, no. Here's again, we need to understand a few key facts so we can act on the basis of knowledge, not emotion. The first fact you need to know is that there were 34 bear markets in the 115 years between 19,000 and 2015. In other words, on average, they happen nearly once every 3 years. Most recently, bear markets have occurred slightly less than often. In the 70 years since 1946, there have been 14 of them. There's a rate of one bear market every 5 years. Depending on when we start counting, it's fair to say that bear market have historically happened every 3 to 5 years. At that rate, if you're 50 years old, you can easily live through another 8 or 10 bear markets. You and I both know that the future will not be an exact replica of the past. Still, it's useful to study the past to gain a broad sense of this recurrent pattern. As the saying goes, history doesn't repeat itself, but it's rhyme. So what do we have? So what do we learn from more than 8 centuries of financial history? We learn that bear markets are likely to continue happening every few years, whether we like it or not. As I said before, winter is coming, so we would better get used to it and prepare. How bad does it get when the market really crash? Well, historically, the S&P 500 dropped by an average of 33% during bear markets. In more than a third of bear markets, the index plunged by more than 40%. I'm not going to sugarcoat this. If you are someone who panics, sell everything in the midst of this mayhem, and lock in a loss of more than 40%, you are going to feel like a grizzly bear mullet if you for real. Even if you have the knowledge and fortitude not to sell, you will likely find that bear markets are a gut ranking experience. Even an old warehouse like my buddy Jack Bogle admits that there are no walk in the park. How do I feel when the market goes down 50%? He said. Honestly, I feel miserable. I get knocked in my stomach. So what do? I get out a couple of my books on staying the course and reread them. Sadly, many advisors fall victims to the same fears and hide under their desks during this tumultuous time. Peter Maluk told me that the ongoing communication during these storms is what set creative planning apart. His company is the proverbial lighthouse broadcasting the message, stay the course. But here's what you need to know. Bear markets don't last. If you look at the chart on the next page, you will see what happened in the 14 bear markets we have experienced in the United States over the last 70 years. They vary widely in duration from a month and a half to nearly 2 years on average. They lasted about a year. When you are in the midst of the bear market, you notice that most of the people around you become consumed with pessimism. They start to believe that the market will never rise again, that their loss will only deepen, that winter will last forever. But remember, winter never lasts. Spring always follows. The most successful investors take advantage of all that fear and gloom, using these tumultuous periods to invest more money and bargain price. Sir John Templeton, one of the greatest investors of the last century, talked to me at length about this in several interviews I did with him before he passed away in 2008. Templeton, who made a fortune buying cheap stocks in the midst of World War II, explained the best opportunity comes in times of maximum pessimism. Freedom number 6. Bear markets become bull markets and pessimism become optimism. Do you remember how fragile the world seems in 2008 when banks were collapsing and the stock markets was in free fall? When you picture the futures, did it seem dark and dangerous, or did it seem like the good times were just around the corner and the parties were about to begin? As you can see from the chart on the next page, the market finally hit rock bottoms on March 9, 2009. And do you know what happened next? The S&P 500 index surged by 69.5% over the next 12 months. There's a spectacular return. One moment, the market was reeling. The next moment, we began one of the greatest bull markets in history. As I read this in late 2016, the S&P 500 has risen by an astonishing 266% since its low point in March 2009. You might think that it was a freak occurrence, but as you can see on the chart above, the pattern of the bear market suddenly gave away. A bull market has repeated itself again and again in America over the last 75 years. Now can you see why Warren Buffett says he's like to be greater when others are fearful? He knows how quickly the mood can switch from fear and despondency to exuberant optimism. In fact, when the mood in the market is overwhelmingly bleak, super investors such as Buffett tend to view it as a positive sign that better times lie ahead. You see a similar patterns when it comes to consumer confidence, which is a measure of how optimistic or pessimistic consumers feel about the future. During a bear market, commentators often remark that consumer spending has fallen because people are so nervous about the future. It's a vicious cycle. Consumers spend less money, so company makes less money. And if companies make less money, doesn't that mean that the stock market won't be able to recover? You might think so, but these periods of consumers' pessimisms are often the ideal time to invest. Look at the table on the next page and you will see that an array of bull market began when consumer confidence was at a low point. Why? Because the stock market isn't looking at today. The market always look at tomorrow. What matters most isn't where the economy is right now, but it's where it's headed. And when everything seems terrible, the pendulum eventually swings in the other direction. In fact, every single bear market in US history has been followed by the bull market without exception. The record of incredible resilience had made life relatively easy for long-term investors in the US market. Again and again, bad times have eventually been followed by good times. But what about other countries? Have they seen a similar pattern of bear market being followed by bull markets? Broadly speaking, yes, but Japan has had a much tougher experience. Remember the 1980s when Japanese companies seemed poised to rule the world. Japan stock market index, the Nikkei 225, rose sixfold during those years of gigi optimism, hitting a high of 38,000 in 1989. Then the market got blown to bits. By March 2009, the Nikkei had sunk to a low of 7,000. That's an 82% loss over 20 years. In recent years, though, it has staged a strong comeback, recovering to a high of 70,000. Even so, the Japanese market is still way below its peak after nearly 3 decades. As we discuss later, you can protect yourself against this sort of disaster by building a portfolio that's broadly diversified globally and also among different type of assets. The stock market is a device for transferring money from the impatient to the patient by Warren Buffett. Did you ever listen to the news and hear the announcers mentions that the stock market just hits all-time high? Maybe you got that queasy feelings that we're all flying too close to the sun, the gravity was about to do its thing, that the market would inevitably fall back to earth. As I write these words, the S&P 500 stands just a few points below its all-time high. In recent week, it hits new high on multiple occasions, and as you know, this bull market is more than 7 years old. So the possibilities that we may be due for fall has probably been on your mind as well as mine. It certainly makes sense not to take carefree risks when stocks have sold for years. If there is one lesson from Japan's experience is that we humans have a natural tendency to get carried away and lost signs of dangers when stock prices have been surging. But the fact that the market is close to its all-time high doesn't necessarily mean that there is trouble ahead. As we discussed earlier, the US market has a generally upward bias. It rises over the long term because the economy continues to grow. In fact, the US market hits an all-time high on approximately 5% of all trading days. On average, that's once a month. That's to inflation. The price of almost everything is at an all-time high almost all the time. If you don't believe me, check the price of your Big Mac, your cafe latte, your candy bar, your Thanksgiving turkey, or your new car. Chances are they are all priced at all-time high too. Freedom Fact 7. The greatest danger is being out of the market. I hope you agree with me by now that it's not possible to jump in and out of the market successfully. It's just too difficult for regular mortals like you and me to predict the market's movement. As Jack Bogle once says, the idea is that a bell rings to signals when investors should get into or out of the stock market is simply not incredible. Even so, the fact that the market is hovering close to an all-time high might tempt you to play it safe by waiting on the sidelines in cash until stock price have fallen. The trouble is sitting on the sidelines, even for short periods of time, might be costliest mistakes of all. I know this sounds counterintuitive, but as you can see in the chart below, it has a devastating impact on your return when you miss even a few of the market's best trading days. From 1996 through 1915, the S&P 500 returned an average of 8.2% a year. But if you miss out on the top 10 trading days during those 20 years, your return dwindled to just 4.5 per year. Can you believe it? Your return would have been cut almost in half just by missing the 10 best trading days in 20 years. It gets worse. If you miss out on the top 20 trading days, your return dropped from 8.2% a year to a paltry 2.1%. And if you miss out on the top 30 trading days, your return vanished into thin air, falling all the way to zero. Meanwhile, studies by JP Morgan found that 6 out of 10 best days in the market over the last 20 years occur within 2 weeks of the 10 worst days. The moral, if you got spooked and sold at the wrong time, you miss out on the fabulous days that follow, which is when patient investors made almost all of their profit. In other words, Market's turmoil isn't something to fear. It's the greatest opportunity for you to leapfrog to financial freedom. You can't win by sitting on the bench. You have to be in the game. To put it another way, fear isn't rewarded. Courage is. The message is clear. The greatest dangers to your financial health isn't a market crash, it's being out of the market. In fact, one of the most fundamental rules for achieving long-term financial success is that you need to get in the market and stay in it so you can capture all its gain. Jack Bogle put it perfectly. Don't do something, just stand there. But what if you get into the market at exactly the wrong time? What if you get unlucky and you hit immediately by a correction of a crash? As you can see in the chart below, the School Center of Financial Research studies the impact of timing on the return of 5 hypothetical investors who had $2,000 in cash to invest once a year for 20 years, starting in 1993. The most successful of these 5 investors, let's call her Miss Perfect, invest their money on the best possible day each year, the day when the market hits its exact low point for that year. These mythically investors who perfect time the market for 20 years running end up with 87,000. The investor with the worst timing, let's call him Mr. Hapless, invested all of his money on the worst possible day each year, the day when the market hits its exact high point for that year. The result, he ended up with 72,000. What is striking is that even after this 20 years run of spectacular bad luck, Mr. Hapless still made a substantial profit. The lesson: if you stay in the market long enough, compounding works its magic, and you end up with a healthy return, even if your timing was hopelessly unlucky. And you know that the worst performing investor wasn't the unlucky. The worst performing investor wasn't the unlucky one, but the one who stayed on the bench, the one in cash. He ended up with only 51,000. Free at last. In this chapter, you learn 7 facts that you show you how the market works. Based on more than a century of financial history, you now understand that corrections, bear markets, and recoveries follow similar patterns again and again. Now that you have the power to recognize these long-term patterns, you will also have the power to utilize them. Later in this book, we will explain in depth the specific strategy you can use to take advantage of this seasonal pattern. For example, we'll show you what to look for when creating your ideal asset allocation strategy so you can minimize your loss in a bear market and maximize your gains when the market rebounds. But for now, you should have a big smile on your face. You know the fact, you know the rules of the game, you know that corrections and bears are to be expected, and you soon learn how to take advantage of them. You are one step closer to being truly unshakable. Best of all, you are taking control of your financial life. You are taking responsibilities because you know what? Most people never take responsibilities. They prefer to blame the market for whatever happens to them. But the market never took a dime from anyone. If you lose money in the market, it's because of a decision you make. If you make money in the market, it's because of a decision you make. The market is going to do whatever it's going to do, but you determine whatever you win or lose. You're in charge. This chapter has taught you that financial winter is always followed by spring, a lesson that will allow you to proceed without fear, or at the very least, a lot less of it. Knowledge brings understanding, and understanding brings resolve. You won't be the person who pulls your money out of the stock when the market is getting slumped. You'll be the one who stay in the game for the long haul, planting that right seed, nurturing them patiently, and then reaping the harvest. But in the next chapter, you will discover that there is one thing that is actually healthy to fear: financial firm that charge clients like you and me outrageous fee for lousy performance. As you'll see, there's no more powerful way to take control of your financial than to cut out this excessive and often hidden fee. How will you benefit? You'll save at least 10 years of income. How's that for taking charge? So turn to the page and let's expose those hidden fees and half truths.